All right, let's talk about Forex. If you've ever heard people talking about currency trading and it just sounded like complete gibberish, trust me, you are not alone. So today, we're going to break it all down, piece by simple piece, right from the very beginning.
And look, this is probably why it's so confusing, right? You get hit with definitions like this. I mean, sure, it's technically correct, but it's packed with jargon that means absolutely nothing to a beginner. It's just not helpful.
But here's the thing. Forex isn't actually that complicated. The explanations are complicated. So that's what we're going to do right now. Let's fix that. We're going to strip it all back to its core, assuming you know absolutely nothing to start with.
Okay, first things first. Let's get to the absolute core idea here. Just for a minute, forget all the crazy charts, forget the online ads promising you a fortune. What is this thing really, and why does it even exist?
So, at its very heart, Forex is just foreign exchange. That's it. It's simply the system people use to swap one country's money for another's. Seriously, if you've ever gone on vacation and changed, say, your pounds for euros at the airport, congratulations, you've already used the Forex market. That's literally all it is. See?
And this is a really crucial point. Forex isn't some fake system that was just invented for traders to play with. No, it is the essential backbone of global business. Think about it. A company like Mercedes, right? They sell cars in the US, so they get paid in US dollars. But their workers in Germany need to be paid in euros. So what do they have to do? They have to exchange those dollars for euros. And this kind of thing, it's happening millions of times a day all over the world for trillions of dollars.
And this really puts the sheer scale of it all into perspective. All the global stock markets combined, they trade about 200 billion pounds in a day. That sounds like a lot, right? Well, the Forex market, it trades over 5 trillion pounds every single day. So the big question is, why has hardly anyone heard of it? Well, it's because, unlike, say, the New York Stock Exchange, there's no big building with a bell you can ring. It's completely decentralized. It's all happening electronically between banks across the globe. It's the biggest market in the world, but it's also kind of invisible.
Okay, so now we know what it is and why it exists. Let's start learning the language. And honestly, to understand a Forex chart, you really only need to get your head around two simple ideas: pairs and pips.
Now this right here is a really fundamental shift in how you have to think. See, when you buy a stock, you're buying one single thing, a share of Apple, for example. But in Forex, you never ever trade a currency by itself. You're always trading the relationship between two currencies. You're trading the value of one against the other.
And that's why you always see currencies written in pairs, like EUR/USD. Reading it is actually super simple. The first currency, that's the base, and the number just tells you how much of the second currency, the quote currency, it costs to buy 1 unit of the base. So if you see EUR/USD equals 1.1650, all that means is that 1 euro costs you 1.1650 US dollars. That's it. It's just a price tag.
All right, next up is this word you'll hear all the time: pip. Seriously, don't let the weird name throw you off. A pip is just a tiny, standard unit for measuring movement. Think of it like a centimeter or an inch. It's just a way to measure distance on the chart. For most currency pairs, it's just that fourth little number after the decimal point. That's it. It's just so all traders can talk about how far prices moved using the same language.
Okay, and listen up, because this is probably the single most important thing to understand about pips. They measure distance, not money. I'm going to say that again. Distance, not money. So if someone says a currency moved 50 pips, that just tells you how far it traveled on the chart. The actual cash you make or lose on that move, well, that depends entirely on the next thing we're going to talk about. So if a pip is just distance, what actually determines how much money that distance is worth? Well, that brings us to the engine room of a trade: lots and leverage. These two things are what control your financial exposure and, most importantly, your risk.
Okay. Of everything we're talking about today, lot size is probably the most critical concept for any beginner to really get. I want you to think of it like the volume knob on a stereo. This knob determines the financial value of every single pip. If you turn the knob down, use a small lot size, each pip is worth very little money. If you crank the knob up, use a large lot size, each pip is suddenly worth a lot more. This one knob, it controls everything.
And check this out, because this slide shows this perfectly. We've got two traders, Trader A and Trader B. They both take the exact same trade. The market moves against them by 20 pips.
But look at the difference. Trader A, who's using that small volume knob, that small lot size, they lose just 2 pounds. They're calm. They can analyze what happened. But Trader B, they crank the volume knob way up. That same 20-pip move cost them 20 pounds. And what's their first reaction? Panic. I need to make that back. It's the same trade, same chart, same everything, but a totally different emotional and psychological experience, all because of that volume knob.
And this really gets to the heart of it. When you're starting out, your lot size, your position size, is not a tool to try and get rich quick. It's a tool to manage your emotions. You want to keep the stakes low enough so you can actually think clearly and not let your emotions take over. Here's a good rule of thumb. If a normal little wiggle in the market makes your heart start pounding, your lot size is way too big.
So what about leverage? You hear this word thrown around all the time, and it sounds scary. But honestly, it's just an amplifier. That's all it is. It magnifies the outcome of the decisions you're already making with your lot size. Leverage itself doesn't blow up accounts. What blows up accounts is using that leverage to turn the volume knob, your lot size, way, way higher than your account can handle.
All right, so we've covered the what, the why, and the how. Let's bring it all together now and talk about the single most important thing for anyone who's just starting out: having the right mindset.
So let's just do a super quick recap of the building blocks we've put in place. Number 1, Forex is just the exchange of global currencies, nothing more. Number 2, value is always relative. It's always traded in pairs. Number 3, movement is measured in pips, and pips are just distance. And number 4, the most important one that you control. Your financial risk is all about your lot size. It's your volume knob.
And this all leads to one final crucial point. If you're just starting out, your number 1 goal should not be to make money. I'm serious. Your goal should be to understand how this whole system actually works, inside and out. You shouldn't be measuring your progress by your profit and loss statement. You should be measuring it by how well you understand the market and how disciplined you are in following your plan without that emotional pressure.
And that really leads us to the final and most important question of all. You know, after listening to this, you have the basic knowledge. You get how the system works. But knowledge is only half the battle, isn't it? The real question is, what's next? Do you have the discipline to actually apply what you've learned? Can you follow a plan day in and day out? Because that's the challenge that separates everyone who's just curious from someone who might actually become a trader.